Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, July 19th, 2023. It's 11:36 a.m. Eastern Time. I'm starting the video and want to do a quick update on some of the recently highlighted trade ideas. I'm going to start out here with this one only because I got an alert today on this one. So HYFM, all these stocks I'm going to cover different trades. They've all been highlighted either this week or even in recent weeks. I'm going to just start out here with this one again because we had a price alert. So HYFM, this one was mentioned twice. Was first on July 12th, then the following day with a breakout to come. Let me get my arrow tool colored up here, the right color. I'll highlight it right here at... there it is, 92 cents. That's a screenshot from the video. And it continues to run. Again, looking at stocks that are pretty much, to me, these charts are almost the inverse. I made some comments today, answered a few questions on the homepage on the last post. And, the stocks that at least that I've been highlighting for the last, 6 weeks now, to me have almost the inverse charts. They almost mirror the charts of the big tech stocks in reverse. Instead of being extremely overbought at 52-week highs with negative divergences and probably a very low short interest on most of those, I think it's safe to say you have the inverse here with a lot of these beat down stocks coming off 52-week lows or multi-year lows, and that's what looks good on the charts. That's where it's not just, and I know some people make comments they don't want to buy stocks with crappy fundamentals. You got to be a market agnostic if you're going to trade. Trade the charts, don't trade fundamentals. They're two different disciplines. Fundamental analysis is great for long-term investing if you're looking out 5-10 year time horizon, but the charts are going to be more accurate short-term. And again, this is just to kind of beat a dead horse because I continue to see the same comments over and over and over about the NASDAQ 100. Again, we haven't broken that 60-minute uptrend line. I'll get to that at the end of this video, time permitting, do an update on the equity markets. But this is where the opportunities are. And so hopefully some of you are capitalized on these trade ideas. This one was pointed out, what was that, 92 cents? We're already up. It's a penny stock. As I said then, these penny stocks, you got to really be careful and don't put too much into them. But it's up about 20-something% since then. It took out the trend line. It took out the 50-day moving average. And so the price alert gets flirting with this 115 level. So you need to take it out on a solid close. And what I'll do now, what I'd like to do, is when you have a resistance level like that, and it's normal, the volatility, this thing's up 12% today, another 12% on what it's built on the last few days. So I like to then tick it up a little bit. Let's see, today's high was, here we'll zoom in and show you what I do. High was 116, so penny above that. Let's put that there. And now say you can either set an alert at 116 or put it up at 117. And so since I've already run at that level, the next pop above there, and what you want to see too is volume. You want to see volume coming into the stock. You can see today is relatively low volume. You can go down to a 60-minute chart. You might not be able to see my volume bars, but so there's no volume there. So you really want to see that coming in. It means traders have picked the stock up on their radar and a breakout that occurs on above average volume. I like to see 1.5 times or better average volume. Just about all charting platforms will give you that. They'll give you the 60 or the 90-day average volume, sometimes 100-day, and you can put that up there. Some, like this one, for example, the 90-day average volume is 507,000 shares on average for the last 90 days. So, you want to see at least, 750,000 the daily average volume. And there's a formula you can do. If you're an hour into the trading day, take the volume at that point. Keep in mind, in the morning you have the highest spike of volume, and then at the end of the day, volume on a daily chart, when you look at a 1-minute chart, it often looks like a smile. So you take QQQ, for example, and here let's pick a day here. Let's go to a 5-minute chart and just show you these. These are the daybreak lines I have right here. So there's a daybreak line, and so you can see the highest volume comes in the morning and at the close. So here's what I'm talking about. Here's a typical example. There's the daybreak line right here. That means when we opened, the market opened, volume is highest, it goes down. Everyone's at lunch, things taper off and it picks up into the end of the day at close like a smile. So what I'm going at is there's a formula you can use to calculate the average day average or where a stock is tracking. And that formula is, since there's 6.5 hours in a trading day, I wish I had a tool to type out, text here, which I don't. But then you just take the volume at that time. So let's just say, for example, now breakout occurs at 11:30 a.m. Okay, now you have your 2 hours in the trading day. You can take that, multiply that, or divide that, by 2. That gives you the 1 hour. Multiply that by 6.5. There's 6.5 hours in a trading day. That's how long the regular session is. And then divide that out. So you can, a lot of charting programs will give you this formula. But again, just to kind of recap, it's at whatever period you're into the trading day. If it's 2 o'clock, do the math. You're at that point at 2 p.m. You're 4.5 hours into the trading day since the market opened. And so then divide the total volume at that point at 2 p.m. by 4.5. That's going to give you your hourly average right there, and then multiply that out by 6.5, and that will give you to what the stock is tracking for the day. So what I was just saying a minute ago about, and early on, just remember you can temper that down. There's no exact formula, but you tend to have a higher volume spike at the open, and then that tapers off, and you can even see it here on HYFM. This is again a low price stock, but there's that big volume into the close. I don't know if you can see, that's my daybreak line. There was the open, that was the close. And so far today, we are seeing a tick up in volume and in the last few days. Remember, this stock has already broken out. Let me be clear. We already took out the trend line. That was the first buy signal. So we got that the other day, and it was on a pretty decent volume. Nothing, actually not very big. So this is what I want to see a pop. Anyways, don't want to beat a dead horse. Just want to reiterate that this one's up, a good 20-something% since then, but it really needs to pop that 116 level. And I'm going to get to this. I know a lot of you are just giving up on the whole, market calls and all that, but I'm going to show you something in a second that I think is pretty compelling that I haven't showed you yet. I posted it in the comment section under the gold and silver update today. But let's just wrap up on some of the other trade ideas recently. Wheat. So remember, wheat broke out, rallied up, hit the second target, at which point I stated going short. I thought the odds were not just good for reaction, but good enough for a tradable pullback, which it did. I was going on vacation. I said, that week I was on vacation, add down to, but not below T1. But then I came back from vacation, said, look, we are now below T1. And it's a good thing, because if you would have added there, you would have gone down more. So when we started back testing, that's where I highlighted again, it's a new objective entry or new long entry or add-on for those that took profits at T1, T2, which I recommended, figuring there'd be a pullback. And then I've been stating, okay, a back test. The problem with buying a back test is you can continue to back test. So what I like to see after a back test is you start to move away from it. And that's what we've done. And then the other day I just highlighted, we popped up, hit T1, which former resistance. It's once taken out, it was support, then it becomes resistance again. We hit it the other day as highlighted, pulled back. And I said, I like that, because we're now moving off the trend line. And so today we cleared it, and I've been saying for 2 weeks now, really want to see T1 get taken out. That's your next objective buy signal, and it was. And we're up 6.717, over 6% today. Again, we've already hit T2. Is it still a resistance level? Absolutely. Even more so now that we already had a reaction off it. Remember, it was identified as a target in advance because it was resistance. The fact we had another reaction makes it even further validates that resistance level. More eyes can see it. You have another reaction. However, as I've stated before, the fact that the way it works is typically I expect a reaction upon the initial tag of each of my targets. And so once you get that reaction, that's pretty much a check mark. It's done. So it increases the odds. It doesn't mean we can't, stall there again if we get there. We're not far from it now, but it increases the odds that we'll go on through there since it's already been checked, if that makes any sense. So like I said, in other words, as of now, this looks good. And unless, I tell you otherwise, I'm favoring a move up to at least that third target zone, T4, and I might add a fifth target right here. Most likely will at about that 925 level. Let me color that line up for you right now. Again, we'll see how this continues to play out. And, again, corn is just a correlated trade. You can trade corn instead of wheat. It's a very constructive chart as well. So, and I just had a trend line on another stock. You might have heard that little alarm go off a second ago. Let's check that one, GRWG. Okay, flirting with the trend line now. This was one of the cannabis stocks I highlighted the other day. So just be on alert. It's up, 8% today. You want to see these guys break out and start taking volume. On that note, let's just go back to the trade ideas that I covered on Monday. FFIE. This one I highlighted on Monday at 27 cents. Yes, I said it's a penny stock. Yes, high risk, but we're already up 31% on that one. Still going. And again, this is where I see a lot better trade ideas, not just because they're beat down and there's that dash for trash, lower quality names, but the charts are constructive. These are my kind of charts. So anyways, these guys are running, many of these up double digits, and this is just in the last 2 days. And that same video on Monday highlighted SUNW, Sunworks, along with some other solars. It was at 155, which is right here. Where's 156? Close enough. So far it rallied about 35% since then. Pulled back a little yesterday, but we're still up right now about 30% on that trade. That one I highlighted just as it was breaking out. So again, these are where the opportunities are. Probably should give you a first target level on that now since it's going here. I like this level right here. If it can clear, take out these 200 days with conviction. It took it out on that one day, but we pretty much back tested it today. I'm going to give you one other level that I see that stands out right here. And what I'm looking at, guys, are all these reactions here. Reactions. So we're pretty much at that first target right there. First resistance, $2, call it. I'm going to just round it off. Everybody loves round numbers instead of $1.99. Let's make that $2. Next target would be $2.45. Again, it's a game of musical chairs. As long as the music's playing, this is where you want to be right now. Again, I'm not going to take time to go through the 7 market-leading FANG stocks now. I will do that in the next update. I want to update the equity markets for you and show you something else that I haven't highlighted until today underneath the gold and silver update, but I'll get to that in a little bit. Anyways, just wanted to say this is where the music's playing, and the opportunities are infinitely higher than the stock market. The stock market is inching up, and incremental percentage points, percent here, 0.5%. But for the most part, again, has gone hardly anywhere for the last couple months or so. And these guys are moving. This is where the opportunities are. ASXC, I highlighted that at 62. We're right about where we were. This one was highlighted right here the other day. Remember, beautiful bullish falling wedge breakout. This looks to be a bullish pennant pattern. That is more of a flag here on the 60-minute chart. You have an impulsive leg up followed by flagging type action. So if the music continues to play, you want to see a breakout of that flag right here, and you want to see it impulsive. And then your measured target's going to be the distance of the flagpole to the highest part of the flag. Add that line to the lowest part of the flag just before it breaks out, and that would give you your measured target. Here's how I do it on stockcharts.com. I take a line there, add it to the bottom of the flag. Again, we haven't broken out yet. That flag could get a little larger, and that would give you a measured target up there at about 83 cents. And so from if hit, again, we entered at 62 or was highlighted at 62, that'd be a whatever it be, 62 up to there. If hit, 35%. All right, BHC, that one's still yet to go. Remember, I differentiate between actionable trade ideas and trade setups. This one's a trade setup. This one needs to pop this 930-ish level with conviction. Again, look for increased volume. If it does, like I said, very big thin zone ahead. That one could really run, but it hasn't yet to take off. RUN was another solar highlighted then. RUN was at 21.19 and showed you going up to the trend line. So here's one, for example, that here's 21.21, close enough. So I'm just trying to measure. So far, we're good for about a 10% gain on that, right into resistance. So if you took it, one of two things. Take profits, get your quick 10%, get out and run, and wait for a breakout above that level. Because usually when you're going on a pretty strong run, it's taken this stock, has had to spend a little energy to get there, about a 42% run just to get to the trend line. It could pop it and run. There's momentum in the sector right now. It could certainly do that. But usually when you expend that much energy to get up there, you're going to consolidate a little bit, and that would be ideal to help work off the overbought conditions and then break it out. So either take profits or raise your stops, at least to maybe break even at this point so you don't lose anything, nothing ventured, nothing gained, and then or wait for a breakout above the primary downtrend line to trigger a long entry or an add-on to that one. If you're, again, I speak because there's a million and one ways to trade. Take the quick 10%, get out, wait for the breakout, or just raise stops at this point and let it run as long as the momentum is in the sector and your stop's not hit. AY, I mentioned the other day in the same video, Monday, again, all these, you had AY was highlighted, I guess about right, well, where were we? Let me just do this. I didn't write it down. That was 2 days ago. Oh, okay, it's right there. We had just broken out. Yeah, this one's just consolidating. I highlighted the breakout. So beautiful looking chart. And nothing else to say. It's still an objective add-on. We just broke out and it's not run away yet. It's probably waiting for some volume. You can see here the breakout has occurred on below average volume, so that makes it a little suspect. Keep your stops relatively tight, maybe below that recent reaction low right here from yesterday. And that one, looks good up to, let me give you a lower target, because this dash or trash I don't believe will continue forever. I know it won't continue forever. I just mean it could at any moment the music may stop playing. And what might be the catalyst for that? Big FANGs reporting. The market's either going to like what they're selling, and I'm talking about Apple, Alphabet, the whole lot of them. You have Netflix and Tesla kicking it off tonight. Netflix doesn't move the needle as much as it used to. It's not the weighting isn't what it used to be, but Tesla most certainly can set the tone. And then you're going to follow up with all the other big ones in the next 2 weeks here. Okay. A couple more I highlighted in that video on Monday as well. Nova, NOVA at 22.26. Right here, 22. I won't be able to zero in. That's close enough. 22.22. Already ran about 10%, and it's right now at that first target I gave you, 23.90. So you can, again, take a quick 10%, get out, wait for pullback, or raise stops and let it run. The chart's constructive, breakout back test, and there's a primary downtrend line that looks like a magnet for a target as long as the music continues to play. SPWR was the last of the solars I mentioned for you, and that one has since broken out. That one was mentioned at $11 even, and we're at $11.54 right now. So let me grab, if I can grab 11. Close enough, 10.95. It's already run about, 10, we'll call it 10% because I grabbed it 10.95. It says 11.27% right there. But that's it. That's a breakout. That's a breakout on volume. You can see my volume bars down below. That's what you want to see. There was your breakout candle, big green candle on above average volume, follow through, and that's it. So, okay. So the takeaway is that's where the opportunities continue to be right now. These charts still look more constructive, but now let me show you what I wanted to talk to you about. I won't go into a detailed market analysis. You already know that yesterday we broke that minor trend line on the NQs. Q, if you're an active trader and you want to short the Qs, that was a sell signal, but we don't have a swing sell signal. As I continue to reiterate, unless we take out those 60-minute uptrend lines and the majority of the market leading FANGs break those support levels I highlighted, especially Apple. That one's probably the most important one. We don't have anything remotely close to an all-in or aggressive, short position on the NASDAQ 100. On the contrary, the uptrend continues. However, here's what I wanted to show you. So I gave you gold and silver today. I got that update out to you and said, not only, okay, we hit a profit target in gold. Remember yesterday we were a hair shy in silver, hit it to the button. You have the negative divergences, but I showed you the euro, which I always like to trade my gold and silver and GDX trades. I always want to align it with the US dollar. There is a nearly immutable and very strong positive correlation with gold and the euro, meaning both go up and down together, which is because there's there's an inverse correlation between gold and US dollar. So it's easier for me to show you the positive correlations than, in other words, follow the euro, and this is where gold's going to go. And again, if you don't believe me, I've only covered this a million times, but I know there's always new folks to the site. So we have, we'll do GLD here, and now I have to change this out. Let me do it over here for you. Yeah, let me do it on this board. Okay, there's gold, and all you have to do is put up FXE. Now, you don't want to use Euro USD on this comparison because that one trades around the clock. FXE is the Euro ETF, and that's going to trade 9:30 to 4 p.m. because it's an ETN, excuse me, technically speaking. And there's that unmistakable positive correlation, the white line. So make no mistake about it. Don't pay attention to differentials when you're looking at correlations. Currencies don't move nearly as much in percentage terms day to day as does gold or the equity markets if you're comparing. Look at the inflection points when each peaked. Look at the trends. We're each going up or down. So that's that. You cannot argue that. And it's math. This isn't some obscure correlation that just exists and has been proven right for years, kind of like that yield curve thing right now, predicting the last seven recessions with a 0% failure rate over the past half century or so. That may not prove to be the case going forward. We'll see. So far, you have a lot of, hardcore permabulls saying, it's worked in the past, but this time it's different. Famous last words in investing and trading, right? This time it's different. But so that's been, there's the correlation here. And let me turn that off. And then show you the Euro US dollar, which I already did today. You got that chart out too. There's a beautiful textbook bearish rising wedge with a breakdown. We're moving lower with negative divergence at the high, just like you had negative divergence here, and that led to this correction, just like you had a bullish falling wedge with positive divergence, which led to this rally, and so forth and so on. So if the charts play out, and that's the big if, sometimes they don't. Nothing is 100%. If you could identify bullish and bearish falling wedges or head and shoulders patterns or cup and handles or any of these bullish and bearish technical patterns or even divergences, and then have 100% success rate that they're going to play out every time they trigger, your wealth would be infinite because you would just leverage up to the hilt on every trade and you'd have 100% success rate. And but it doesn't work that way. So what I want to say is right now it is a clear 110% breakdown bearish pattern, and I don't see any reason why it's not going to play out. All I can tell you is sometimes they don't. Sometimes they do play out, but then what happens is you break down and boom, you go and back test at a higher level and then it plays out. So those are all the variables involved. But as of now, it looks good. Looks like we're headed lower. And let me wrap this video up showing you what I was mentioning earlier. Okay, so this is let me put in FXE. Okay, so I showed you just a minute ago the unmistakable positive correlation between the euro and gold, which is an inverse relationship between the dollar and gold. And it's simply that gold, as we're looking at it here when I showed you GLD, the gold ETF, or GC gold futures, or you go down to your local jeweler or your pawn shop and you want to buy a brick of gold or a gold coin. That gold is priced in US dollars. So if the dollar is going down, US dollar is dropping in value, then it's going to take more dollars to buy 1 ounce of gold if you freeze supply and demand. And if the dollar is strong, the dollar is rising, it takes fewer dollars. And that is that reason why that is a nearly immutable correlation. The only reason I say nearly immutable is because there are times where the dollar can go down and gold doesn't go up if there's an overwhelming supply issue, meaning a lot more sellers of gold for whatever reason than buyers. But again, it's been a historical correlation. Go back on your own, go back 30, 40, 100 years, as long as your charts will go back and you'll see that correlation. So now what I wanted to show you is that correlation, and I've showed this many times in the past, just not recently. It is also a very strong correlation with the stock market. So what we have here are 3 things. Again, this chart, you can reference it right here on the site. Go to that post I put out this morning on gold, and then here's the chart. So here, we'll just look at it here. So it's not dated yet. I just put this out shortly before the video. All right, in white you have the euro as using FXE, because again it's going to trade at the same exact times SPY and QQQ will. That's why I'm not using EUR USD. And there's the unmistakable correlation. They go up and down together, right? And the correlation is super strong. Here's where the euro peaked, and what happens is a euro tends to peak have its peaks and troughs quite often. Not always. Sometimes they're concurrent, but sometimes you get a little bit of a heads up, which kind of indicates, because it's that whole chicken or the egg thing. So it may indicate that the euro might have the bigger impact on the market. Either way, you can see when they peak, they all go down together, they all bottom together and go up together. And so that's it. So now the $1 million question is, will this breakdown in the euro play out or not? If it does play out, then there is a very strong chance, high probability, that it will also bring the stock market down with it, because of that very strong positive correlation I just showed you. Here's FXE on a daily time frame. Again, FXE is the euro ETN, and you had really a series. This is a mistake. That's DH1, DH2, and then DH3 right here. So you can see a series of divergent highs. I always say it's not as if these don't work. There's no guarantee. Sometimes divergences do get burned through, but more often than not, they play out. Smaller divergent high lead to a correction, divergent high 2. And now we have, this is all an extension of the same divergences that started back here when the indicators peaked. And so should this play out, then it could easily take us down to this primary uptrend line, which actually forms a big old wedge. And that could be send the euro all the way down here. Something to watch right now. Go to euro US dollar. That's where I showed it to you on the 60-minute chart earlier. That's the chart I got out to you with the gold and silver post. Here's what it looks like on the daily. I mean, it's obviously a clone of what I just showed you, FXE, except you have, again, longer trading around the clock in this Forex pair. Divergent high 1, divergent high 2, and now divergent high 3, which, let me draw it out here. There it is. There's your divergence lines. Pretty much equal highs on the RSI down there. Okay, and then the last thing we'll do, because Tesla reports tonight, and Tesla is one of the, they call it the Magnificent Seven or whatever they're calling them now. Remember the little FANG acronyms, long since been retired. There's been a change in the top components. But here's that downtrend line I've been talking about forever and a day in Tesla, and it's now hit it. And we have pretty strong divergence. What I've always said when we head into earnings season, that when you hold a position, stock, into earnings, there's always a gamble. It's somewhat of a crapshoot. You're either going to be very happy or very sad the next day, because earnings are the one time you can almost count on, especially with certain stocks. I always say, know your security, know your stock. Big gaps. Some companies have a history of making large gaps, up or down after earnings. Others have a very muted response because they do a very good job of managing earnings, or maybe their earnings are more consistent. Think like Pepsi or Coke. Versus something like Tesla, where the earnings can be all over the place. You got Bitcoin holdings in this company that can be marked up or down. You have all kinds of EV credits and government subsidies and everything else. And you talk about a field day for the accountants to move things around on the books. Anyways, the companies like this are prone to having big moves after earnings. But where I was going is, even though it's a random, somewhat of a crapshoot going into earnings, I've said often that the charts typically will indicate if the chart is clearly bullish or clearly bearish. Now, obviously, the trend on this stock couldn't possibly be more bullish. This is a strong, unmistakable uptrend we're in, but the technical posture is bearish, especially these steepening divergences right here on this final thrust up right now, and a rally into the primary bear market downtrend line. So with that being said, my guess is after earnings, the stock does this. Even if, as I said last week, maybe if they pop up tonight, you've got big resistance just overhead as well, and that would be an after hours pop, a rally on there, only to see us close the day tomorrow back down on or below that trend line. Again, that's my guess. But we'll see. We've got a lot more things coming up. It's still obviously a gamble to take it. It's just a gamble with calculated odds that I would put better than 50% that by the end of the week the stock is trading back down below this trend line. That would be my guess. And if it's not, guess what, guys? If we power on through here and keep doing this, then all of a sudden you no longer have divergences. You've taken out big resistance right there. Once the bear market started, this was a level we kept getting rejected at there. Then that's going to be bullish for Tesla and the overall market. And last one, since they report tonight as well, Netflix. My guess on this one, and surprise, surprise, I'm sure there'll be some comments about it, would be a down after earnings, most likely, because you do have also negative divergence here on this final thrust up, and you're also, like Tesla, at big major resistance. This was a trading range right here when Netflix started topping in 2020 into almost the end of 2022. Like almost every other stock in the NASDAQ and the S&P, all the big stocks, the indexes did this as well. Most ended there. Netflix had a breakout, which proved to be a false breakout. It was a breakout that occurred on negative divergence. And as I often say, breakouts that occur with negative divergence and overbought conditions often fail. And that's exactly what happened. That breakout failed. And then, as I often say as well, fewer things in trading are more bearish than a failed breakout. So what happens is, this is what we call a bull trap. That's over a year-long trading range. And that breakout was a tremendous vacuum. It just sucked in a lot of bulls, a lot of new money into the stock. And then when they realized at this point the breakout failed, and then when you can see what happened. And we gapped down. It was probably earnings. So they were in there and they were saying, okay, well, we still have major support at the bottom of that year-long trading range. But guess what happened? And this is what earnings can do to you if you're on the wrong side of it. And this is, again, I believe that was an earnings gap. It's a huge gap. And a stock like this is prone for that. That was a gap down of 23%. And it clearly took that level out. They tried to buy it up. The dip buyers, as they will, couldn't help themselves. They stepped in, they bought it up, but then you can see the sellers stepped in and rejected it hard right on the line on a back test there. And from there, the stock, if you bought that dip in Netflix and held it there, you lost 64% over the next few months right there. That's technical analysis. And so that's where we're at right now. And again, that is a massive level. This was the biggest battle in the last probably decade between bulls and the bear and Netflix. And the bears won. And now this is what the bulls need to take that level back. And if they do, and then they go on, the next resistance is really the top of the zone. If they re-enter this zone, then chances are, a good chance, you'll go to the top of the zone. And then that's bullish if that breaks out. and then bullish if the old highs get broken out. But as of now, we have negative divergence into resistance. And if you're wondering where to, if you want to trade Netflix before or after earnings and it does go down, you have the primary uptrend line right there. That'd be about an 18% drop. And just below that, you have, I'm going to give you a second target if it overshoots that, about right here, roughly 374 right there. You've got a reaction high and a gap right there. So yeah, we'll call it about an 18-20% downside on a Netflix. I don't care if they beat or miss expectations. That to me doesn't matter. It's what the market does. I just wanted to share that these two, again, my guess is both of them down after earnings. And again, does not matter what happens in the after-hour session. What happens tomorrow when the big boys, the starters, step onto the field, the institutions, because they don't really maneuver well in after hours. You don't have the liquidity. So if the hedge funds are going to buy more Netflix in the pension funds and mutual funds, or sell Netflix, most of those orders are going to come in tomorrow morning at 9:30 in the regular session. And then a little pro tip, again, about know your stocks. Just look at the history. You can see stocks that are prone to big gaps, such as Netflix. You can measure those gaps. So then if you are, risk averse, we're all risk averse to a greater or lesser extent. Some of us, have a much larger risk tolerance, but that can help you quantify just how much money might you lose if you go long or short Netflix in earnings. And so factor that in, use the position size calculator I created. There's a little icon at the top of the website for that, and kind of gauge, okay, well, if I'm going to hold this in earnings, I need to be prepared for potentially a 20+% gap against my position. And then know this, I'll talk about this often during earnings season, that there are two types, basically the two most popular types of stop loss orders. So let's say you're going to go short the stock, and you want a stop loss right here, a little bit above that resistance level, out of range of the market makers. Again, be careful in after hours. They're probably going to take your shares. There's a good chance. But even if you do it regular session only, you can code that order. You have two types, stop loss and stop limit. First of all, in the after hour session, you can only use limit orders. Stop loss orders will not apply. So you can only buy and sell limit orders in the after-hour session. Stop loss order says that if you are going to, in the case of a short, if you hit or exceed this price, immediately turn my order. That stop loss order gets turned into a market order. And what that means is if you gap up here, all the way up here tomorrow, there's the stock rips in after hours and opens up at this point, and your stop loss was here. Guess where you get filled? Not here. You get filled here for a big loss. Could be a 20-25%. I doubt this stock's going to gap up 20 big gaps that big usually come to the downside. And that's the thing about gaps too, is that downside gaps are usually much larger. But the other one is a stop limit that says sell me out at this price. Let's say that's 505. But only at 505. A stop limit can only fill at the limit price. And then what happens if you gap up to here and you're short? Well, you still have your stop limit order. It's still there and it's unfilled, and your losses can continue to build because the stock never executed, never traded at 505, traded past there. And that works in reverse for long trades if they have a stop below. So just know the difference there between the stop loss, stop limit. And also know that during earnings season, you're going to get that after hours volatility on the stocks that report after the market closes, and the initial reaction very often is not the final reaction. All right, guys, that sums it up. So I gave you the correlation between the euro and the stock market, the outlook for the euro, the outlook for gold, silver, and then updates on all those trade ideas that I highlighted. That was just in Monday's video. But like I said, those are gonna those little guys are gonna run until the music stops. You don't want to be the bag holder. And with big market leading tech stocks reporting in the next week or two, if there's going to be a catalyst that puts a knife into this strong bull that's running right now, it's probably going to be earnings. So not a bad time, in my opinion, to either raise stops, tighten up stops on those winners that we have that are 10, 20, 30, even 50% plus up right now in the last few weeks, or just close them out, sit back, let the dust settle after earnings season, and then re-engage. Up to you. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart.